Well, I mean, I guess I'd say not very many people, but for a very definite reason. And that is most people in this business are trying to make money for themselves rather than for their shareholders. And so they're not focused on giving the shareholder the best break. And if you think about it at all deeply, you realize that the stock market creates nothing. It reflects the returns earned by investors, by Investment America, the corporations of the country, the public corporations. And they have earnings. They pay out dividends. They reinvest the earnings in the business. That's where the value is created. You access that value. You access that value through investing. So then the question is, corporate America has created this kind of value. What comes down to Investment America? And the answer is exactly what they earn, except that it's then the question is, how is it allocated between Wall Street, essentially the financial system, and Main Street, the people who invest? And the allocation to Wall Street is the objective of this business because everybody is in Wall Street. And what we should be doing is working, and what we have been doing here at Vanguard, is putting the investor first and innovating for the investor and not for ourselves, and trying to keep costs as low as we can, which is rock bottom.
I want to go back to something you mentioned a minute or two ago about the importance of fees and really looking at what you're paying for that return that's being created by corporate America or corporations around the world, and then the fee that is the one interruption for you to actually getting that return. Would you suggest then that somebody who's going through and evaluating a mutual fund to purchase, and there are sites and services like Morningstar and others that have all of the ratings and reviews and they tell you about the manager and all the rest, would you say that the best thing that someone could do would be to remove all of those factors and just rank them by fee and buy the ones that have the lowest fee? If you could do that without looking at anything else, obviously you'd end up with a number of Vanguard funds because your fees are average 0.12%. But is that a better methodology than the average person is using to pick a mutual fund?
Well, I'm tempted to say, and will say, ask Morningstar. They say that their sophisticated rating system works almost as well as simply rating the funds by cost.
Wow.
So they have entered the confessional booth. The problem is, in the financial business, value and cost are the reverse sides of the same coin. When you go into Costco or anything else you can think of, there's a value in your mind. You buy a Mercedes-Benz, you get a lot of value out of driving. Now, I don't know why anybody would get any great pleasure out of that, but maybe it's pride. Maybe they think Mercedes-Benz is a new star somewhere in the sky. I don't know. But you can't directly associate the cost with the value. But in the mutual fund business, it's how the returns are divided up between the marketplace and the investor. So this is a hard business to do it in without giving up your profits. Get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs. And I gave you that example of 7% gross return, net return, 9% gross return, and it's cost you 70% of your capital over your lifetime. Be aware of that. You read in the Wall Street op-ed yesterday that the market will then get inefficient, start to get inefficient as you creep into the 80s and 90% that's not traded, just means a reduction in trading volume. But the reality is that it may get less efficient and it'll be much easier to win. But it will also be much easier to lose because the average manager is always going to do the same as the index because they own the same stocks. That's what the market is. It's a universe. This much is indexed, this much is held by active managers. So you will probably see at some point a division between, if you get way out there, years and years, decades from now, the market does get less efficient. But it doesn't, it will make it easier to lose and easier to win. You can never look at the market without realizing that for every buyer there's a seller. It's a very kind of simple thing that people seem to forget. So I don't worry about that. I do worry about the lack of competition in indexing. The big three, so-called, you mentioned Vanguard and BlackRock and State Street, there's very little competition. We Vanguard are 80% of the traditional index fund market, And nobody wants to compete there. The competition is over in the exchange-traded market, which is a very different piece of cake, and not as good one, I'm sure, not as good a track to be on at all for the investor. And so why don't more people join? Because all the damn money goes to the investors and not to the managers. It's not an attractive business proposition. And the mutual fund industry is basically an industry that is trying to make money on the return of the manager. And of course they want to make money on the returns of the people that invest with them, but they're greatly handicapped by the fact that their prime job is to run a corporation in the traditional way, see how much profit you can make. And the more the manager takes, the less the investor makes. This is just the truth. Well, I fall back a lot of the time on Adam Smith, who wrote his stuff, as it were, in 1776, more or less. And I rely on the invisible hand of the investor to do what's best for himself and therefore change the world for the others. The matter is not in Wall Street's hands. The matter is investors' hands. And if brokers or firms or mutual funds that trade too much are doing the clients a disservice, this will become very apparent and the clients will move their money. That's why we had this huge move into indexing, which is now, I think, 40%, almost 40% of all mutual fund, equity mutual fund assets. Wall Street is a great marketing machine, a great selling machine. And if stocks don't trade, Wall Street makes no money. There was a cartoon in Barron's some years ago with a sober-looking announcer from CNBC saying, there was no trading on the New York Stock Exchange today, as all investors were satisfied with their positions. And that's the Nirvana day that I'm looking for. Because we trade with each other. There's no gain to be found for the market. I trade with you, I may be right or wrong, you may be right or wrong, and there's only one person that makes money, the croupier in the middle. So people will get wise to that, and they will get wiser, kind of the example I gave at the beginning, when returns are lower. Cost, 1%, 2%, let's call it 2%, of a 4% return is half of it, where of a 15% return, we enjoyed 17% actually in the 80s and 90s, it's only 10, you're still left with 15 after the 17% returns for each of those 2 decades, unprecedented in American history. So experience will tell, and they will be moved by what the customer wants, what the client wants. So there should be less trading, even as we bring the exchange-traded fund into a whole new world. Now, ETFs account for somewhere between 30 and 40% of the trading in the New York Stock Exchange every day. There has to be something to sell all the time in Wall Street. And you know, with all due respect, I mean, it's an honest trade, but there's just too much of it going on, and it can't win. Because if trader A wins, I mean, I don't want to beat this to death, but I might as well make it clear. Trader B loses. And so trading is a loser's game.
Stock market is just a big gambling machine, and it's probably rigged too, so I don't invest.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history. The chapter in my book on ETFs is called A Traitor to the Cause. Traitor, not traitor. Wouldn't dare say that, but it is that too. I'm bothered about ETFs. They are, think about it this way, that we have passive investment strategies, call it indexing. And there are 2 groups that own them, passive investors and active investors. And the traditional index funds, TIFs I call them, an acronym which has never been picked up by anybody but me in 4 years or 6 years, and ETFs, to give you the bouts. And ETFs are clearly passive funds owned by active investors. Active investing is trading. Active investing is speculation. Active investing is losing. And ETFs are a loser's game. Let me be very clear about that. Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. So you're going to be, and then you're going to be investing, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive and buying at the high, your money isn't going to last very long.
What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with $15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they get there. They don't really know how much money I put away for them over all these years. And I always put it in balanced index fund. 60% S&P 500, or total stock market, I should say, and 60% total bond market.
60 and 40. You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment throughout life.
Now, it's conservative, and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. Okay. So you don't get exposed to the worst of it. There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. Stocks will return over the long run, not every 25-year period, but probably 3 out of 4. Stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk. You know, if the market goes up, let me say, or down 25%, and you own the market, that's what you do. If you want to reduce the volatility in a balanced fund, you maybe go up or down 15%. And if you want to get an extremely aggressive fund, maybe up and down 40%. But it's symmetrical and fairly symmetrical. And so that's a way of measuring, but it's a short-term thing. In the long term, the risk is that you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money in an all-stock portfolio.
And it took you another 15 years to get back to even or something.
Yeah, actually a little more than, just about right, 15 years in mid-40s. And so those kind of risks are big risks. And they're risks that we can't measure. There are risks that come from things like, what is the probability that our society will collapse? What is the probability that with all the undercurrents that are going on in American society between the haves and have-nots, and the haves, the superior, larger races and the minorities, those gaps are very wide, and I'm deeply concerned that we may get in some real trouble, and that's why I describe myself as so conservative that I'm liberal. I want to protect our society, and therefore I want to protect those segments of society that haven't been treated fairly to the best of our ability. And then there are the known risks, like nuclear war, worldwide disease, plague kind of thing, religious uprisings, the things that we know about and worry about today. And then, as my fellow Princetonian Secretary of Defense Donald Rumsfeld says, those are the known unknowns. And what about the unknown unknowns? And of course, since they're unknown, we can't comment on that, about that.
But none of those unknown unknowns, or none of those big risks, cause you to change your investment approach, I guess, because the assumption is if the market goes down 90% on the Bogle family portfolios, that there are so many other problems in the world, it's probably not going to be a make or break thing for you that your stock portfolio is down.
Well, no, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. And I think that given the enormity of these kind of risks that I've described and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny. And zero is guaranteed. So you have to put your money to work. In the extreme circumstance, even cash is not going to help you. It's not going to be any good if the nuclear bombs start going off. It's a frightening, fragile world that we live in. So you can sit and worry about it every day. And, in certain respects, if you like to worry, it's a good thing to worry about. But you kind of have to get on with your game, prepare for the future, and hope that those extreme risks don't come home to roost. Concerned, angry, astonished. There is a fringe element. It's almost entirely in the ETF industry. That's a marketer's dream. People that have no background in the business, Henry Kaufman calls them financial buccaneers, come into the business with a hot idea. And they want to sell, I won't name any names, they want to sell what's ever hot. And you've read interviews with these managers in Barron's, kind of frightening. And they say, well, I know that Japan and Europe, two of their funds, are currency neutral funds, aren't going to last forever. So we'll think of something else when they fail. Was that the way to be in this business? To market products? I don't even like the word product. I banned it here, actually, years ago. It'd come back. I used to pay a $5 fine if you ever mentioned it. I didn't think we were manufacturers selling products. I thought we were trustees selling fiduciary services. People would say, that guy is a real sap, and he probably is. But I have an idealistic view of the business. Well, the book is premised on a wonderful story, which I really ought to tell you, and that is the story of Kurt Vonnegut, the famous author, and Joe Heller, author of Catch-22, and even more successful author. And they went to a party given by a billionaire on Shelter Island, and right off Long Island there, kind of lifestyles of the rich and famous kind of place. And they get in there, and Kurt says, Joe, see that man over there, our host? He's a billionaire. He's a hedge fund manager. And he made more money today, on this one day, than you have made with every copy of Catch-22 that has ever been sold. And Joe Heller looks over at Kurt Vonnegut and says, that's okay, because I have something he will never have: enough. Well, we're actually talking to all of the above, Pam, and that is the money section is about the sins of our financial sector in this economy. Too much overreaching, too much greed, too much lack of awareness of risk, too much financial engineering, making numbers look better than they are. And then I go from there, from the financial sector to business itself, where any aspect of professional behavior and professional conduct and the ethics that go with the role of a professional have been reduced greatly, if not abandoned in many cases, in favor of business, business, business. The idea is to make a buck in this bottom line society, and we've gotten, I think, too much focused on, let's say, the ephemeral, too much focus on charisma, and not enough focus on the eternal, and not enough focus on character. So business, general business, in the U.S. particularly, but all over the world, and part because of greed, human greed, has gotten the message wrong. And then finally, the third section of the book is on us, if you will.
Us meaning the ordinary investor, the ordinary working person.
The ordinary citizen.
Right.
And that's the part that's the life part, how to live a life, an enjoyable life where you have enough. Now, a good question is, what is enough? And I think that's the question you ask, and I don't know really how to answer that question. I don't think anybody, because it's a very personal thing. It certainly has a lot to do with things other than money. It has to do with serving the community. It has to do with being a part of a family and raising a family. It has to do with how we handle our colleagues. It has to do whether we make a contribution to the welfare of this great land of ours. And it also does have to do with money. And where money comes out, because we all want enough so we're not burdens for our children or whatever it might be. The best definition I could come up with comes from the Roman poet Horace, a couple of centuries back there. And he said, look for the golden mean, somewhere between the agony, the ignominy maybe of a hovel, and the envy of a palace over here.
But what about the concept that if we see a market continue to decline, that people will be disappointed in all index funds because they find that the managers are not allowed to sell to get out of the market?
Well, the fact of the matter is that the index fund has traditionally carried about 20% less risk than the average fund. In other words, for all the vaunted ability of mutual fund managers to raise cash, they've really been doing just the opposite. They had 14% in cash at the beginning of this bull market and 4%, only 4% at the peak. They were bearish when they should have been bullish, and bullish when they should have been bearish. So the index at least steers a steady course.
Do you still expect, Mr. Bogle, that if this becomes what people call a stock picker's market, that the index funds will continue to outperform the stock pickers?
I don't think there's such a thing as a stock picker's market, Tyler. All investors are picking all stocks, and to the extent an index fund owns all stocks, it's a sort of contradiction in terms, because if the good stock pickers take all the good stocks, the other half of the market will be owned by the bad stock pickers who pick the bad stocks. It all comes out to a sum of one. Well, this is a great time to ask that question, because it seems pretty clear to those of us who are expert, who may know nothing, never forget that, that we're going into an era of much lower returns than we've been accustomed to in the past. And how that will play out, nobody knows. I would be in the camp of saying the market is significantly, not grossly, but significantly overvalued. And assuming that's correct, there are only two things that can happen. You can have a long period of very low returns, or a great big drop in the market, 30%, 40%, even 50%, and then get back to the good returns of the good old days. That's a hard way to do it. But it seems almost inevitable that returns will be lower somewhat than this 35 years or so that we've had the greatest bull market in recorded history, with the S&P 500 growing at 12% a year, which means, mathematically speaking, simply enough, that if you started with the S&P 500 35, 40 years ago, you now have $60 for every dollar you started with. And so it's not genius, it's the market. And you kind of wonder how the mutual fund industry has held itself together against the onslaught of indexing. And I think the answer to that is, in this great bull market, if you had a 10% return, which is roughly what the average fund has given you, you got 40 times your money instead of 60. Well, nobody's looking at the 60, and they're saying any manager that can take my dollar or take my $10,000 and turn it into $40,000 is my friend forever. And he's a genius, and he's actually fallen way short of the market. So one of the lessons is, I think, or one of the messages, perhaps more importantly, is the trees don't grow to the sky. And I'm really quite confident about that. But confidence in this business is a dime a dozen. So, well, that's a complicated question. But let me just say this for the record. Morningstar counts them as factor funds or strategic beta funds. And they happen to be, these funds I created in 1993, happen to be the oldest and largest strategic beta funds. So how can that be, since I don't believe in factor investing? The answer is pretty easy. I didn't create them to be traded with one another. I created them to be, with the growth fund, to be bought during your accumulation phase, where you have less taxable income and maybe a little more volatility. And then when you get to the distribution phase of your retirement account, you got more income and a little less volatility. Not very complicated. And I warned investors in 2 consecutive annual reports, don't trade them. And then I said, the most likely thing is that in the long term, both growth and value will have the same return. Well, 25 years later, growth and value funds both had a 9.1% return. You can't get an awful lot closer than that.
Right.
And yet the average investor got, I think, a 7% return, the investor now, not the fund, in the growth fund, and a 5% in the, or 7% in the growth fund, I think, and 5% in the value fund. Something like that. I may have the numbers a little bit off. So investors lagged, and if you accumulate that over 25 years, that lag is enormous. So investors did what I told them not to do. I told them not to do it, Christine, and traded it, and to their own disadvantage. So I feel so funny, I don't believe in factor funds. I believe factors come and go. I believe that the coming and going of a factor cycle is unpredictable, and the record, I think, pretty much bears me out. First, let me differentiate between the active managers, let's call them a stock picker. And for each good stock picker, of course, is a bad stock picker, but no way around these things. And then there's asset allocation. How much do you want in stocks and how much do you want in bonds? To me, that is by and large a buy and hold proposition. Don't do something, just stand there, almost no matter what happens, and maybe no matter what happens. For example, even this 50% decline, you ended up with more money 7 years later, from 2007 to 2014, if you just stayed in and just taken your lumps, and it came back if you were in an all-market index fund. So asset allocation is a little different, but there's one thing that is the same. Please don't let anybody forget this. If you're smart enough to reduce your allocation to stocks and increase your allocation to bonds, somebody else is reducing their allocation to bonds and increasing their allocation to stocks.
The logic is the same.
The logic is identical. So if the system is roughly, which it is, depending on how you count the Treasury's debt, which is another interesting story, but roughly a 60-40 situation. So you have the total market allocation for the typical investor, and the variations are not huge. Somebody's going to be 100% in equities, which by definition is the best long-term strategy, and yet you may not be able to handle the bumps. Well, let me correct myself. No, 100% equities is not the best long strategy. 100% equities leveraged, 2 to 1,
There you go.
3 to 1, just so long as you get someone to bail you out at the bottom,
Right.
and you can pay them back later. This is not an easy thing to do, but we all know those fundamentals, and we all know the allocation for the system is fixed for all of us. So we're trading back and forth with one another, trying to prove we're smarter. And I'd say this about Warren. When he's, as everybody knows, decided to, in the money he's leaving to his widow in a trust, he has directed it to be invested 90% in the S&P 500 index fund. Not a bad Vanguard S&P 500 index fund, I should say, because he said it too. And this big bet he has with a hedge fund, which he's winning by a huge amount happily. They're kind of random events. His bet, his side of the bet, is not that Berkshire will do better than the hedge fund, but that the S&P 500 will do better. So he's a huge supporter, and has been for as long as I've known him, of the index fund. And indeed, when I talked to him about Little Book of Common Sense Investing, I said, I'm going to write in the conclusion. I was just working on the book when I had dinner with him I guess that would be back in around 2006. And I said, I'd concluded that Benjamin Graham would be an indexer. Do you think that's fair? And because everything changed, Benjamin Graham recanted a lot of, it's hard to find value anymore. There are too many people looking for it. And he said, of course he was an indexer fund. I know because he told me so. And that was good enough for me, so I put it in the book. But so these are the verities of investing, that you're going to depart from this universe of stocks and bonds. If you depart, somebody else does the exact opposite thing. It's a closed universe. And so in that sense, and I love this point, it's a little bit difficult to do without a chart, but the chart is entitled, We're All Indexers. Look at the total stock market. That's what we all own. Now slice about a third of that out, and those are indexers who know the value of indexing. So they own an index fund, and with no trading, arguably no trading. Then look at the other two-thirds. Those people own the market index by definition, those stockholders. But they're not satisfied with that. They want to bet against each other, and therefore they lose to the index by the amount of transaction costs they have. None of this is complicated. Warren wrote this great piece, which I edited a little bit, for my book, Little Book of Common Sense, about the Gottrocks family.
Yep.
And they were fine as long as they kept to their own devices. But when they started thinking they could beat each other, then they started to do worse. And the costs went up, and the taxes went up. And they did worse and worse until they went back to just buy and hold and don't fight over this with each other. These are verities. Inflation, which you have no control over, eats away at the value of your dollars. You may think you're being safe if you buy a bank CD or an equivalent instrument, and let's say over 10 years. But that instrument's going to lose 30% of its value conservatively over the next 10 years. They'll have a little bit of interest to offset that. But if the dollar is worth 30%, which is roughly 2.5% per year in inflation, that's gone. You've taken a big risk by, in effect, speculating, for the want of a better word, that the dollar will remain unchanged, and it never has. And I don't think in our lifetimes it ever will. Maybe sometime. But so there's the big risk. So when you look at, say, stocks and bonds, stocks at least have a fighting chance to overcome the ravages of inflation. And the way I look at it, I've got some math behind this, because with a dividend yield of stocks about 2%, and potential earnings growth should be in the range of 5%, stocks should give you about 7% over the next 10 years. Gross, before cost, before anything. So that's a fairly conservative number, but I think it's realistic. And bonds should probably give you about 2.5%. So if you think about inflation, if there's 2.5% inflation, and the bond gives you 2.5%, you're doing a break-even investment over the next 10 years. And that's just, you need more than that if you're going to build a retirement fund.
And if you have X dollars and you're getting 0%, and even if you're living frugally, you're still reducing the purchasing power and the actual amount of money that you have.
Yeah, and importantly, we live in a way, and I've said this before, in the most difficult time to invest that I've ever seen. And the reason for that is, yes, stocks have more volatility risk. They go up and down, and bonds stay pretty steady from day to day. But you have to take into account not only the risk, but the return. And the return on stocks, I think, is, I'm close to saying destined to, but I won't go that far. I'll say highly likely with a 7% expectation, which could be right or wrong, but it's certainly very likely to be to 2.5%, almost certainty, for bonds. And actually, I'm being generous to bonds, because the government bond, the 10-year Treasury, is yielding 1.6% today is all. So you've got to take a little bit of risk in corporates, and I would frankly take a bigger risk in corporates. But so ask yourself this question, which is riskier for the next 10 years? That bond, which will give you a low return, but probably not very much, or the stocks, which are highly likely to give you a high return, but with volatility along the way. And for that reason, I like the idea of a balanced portfolio, some stocks and some bonds, although you have to think about it a little bit differently today with interest rates at these floor Price money market funds are basically not even worth buying. The average yield of a money market fund is, I think, 0.2%. People should buy very short-term bond funds, my opinion, high-quality short-term bond funds instead. So there are ways to do it, but you have to look at just not volatility risk, but the entire picture of investment risk to dividend income, risk to your income. If you're giving up a 2.5%, 2% stock yield and getting only 1% from a CD or whatever it might be. Today, one of the best examples is returns on stocks. The historical return of stocks is 9%. So people say, I want that 9%, so I'll go into stocks. That was the last war. Today, stocks are going to give a future return about 2% less, or maybe more than that, a bigger shortfall. Why is that? It's so obvious. And that is that 9% over 100 years is 4.5% dividend yield on stocks and 4.5% earnings growth. 9 total return from investment. And today the yield on stocks is 2.1%. So forget that extra 2.5%, strike it. And when you go through the math, you'll see that the future return is going to be 6.5% or 7% compared to history. Don't listen to history. It's interesting, and it may rhyme, as Mark Twain said, but it doesn't repeat itself. Well, first we start off with a simple kind of an equation, if you will. And that is when you take the total return of the market, that's the return that all investors share in gross, and after you take cost out, it's a loser's game. Investors lose to the market. Total market has, however measured, S&P 500, total stock market, it really doesn't make much difference. That total stock market index, the old Wilshire 5000, and take out about 2% a year for the cost of investing. And it may sound a little high, but you have like a 1% expense ratio for a typical mutual fund. A typical mutual fund turns over at about 80% a year. Just think of that. Short-term trading, I mean, that's the business. Average holding period for a stock, I don't know, a year and a half, something like that. And that costs money. And if you say that costs another percent, that's the 2%. And you've eliminated the fees of an investment advisor to pick the fund, another 1%. You've eliminated sales loads, you haven't counted them. That's another 1 or 2 or 3%, however. So 2% is really a decent but moderate estimate. And so if you're in the market for a lifetime and you earn don't hold me to this, I think I just did maybe 50 years, and you earn, let's say, a 7% return, you'll end up with, say, $30 per dollar, something like that, invested. And if you do it and earn 5%, that's the 7% in the market, less the 2% playing the game, you end up with $10. So you've given up 2/3 of your return, $30 versus $10. You've given up $20 of return to the market system. So think about it this way, Rana. You put up 100% of the capital. You took 100% of the risk, and you got 1/3 of the return.
Yeah, not a great deal.
If that seems like a great deal to you, yeah, maybe I'm not making myself clear. So all this depends on a long-term time horizon. Doesn't matter much in a year. All this depends on low cost, which has come totally into its own. And all of this accounts for the burgeoning of indexing. Buy right means diversify, diversify, diversify. In an index fund, which is a great way to invest, for reasons I've talked about earlier, you at low cost and all that, but you're diversified, so the intricate ins and outs of the market, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better, or technology is doing better. If you own the whole market, you get your share of all of that. So, but that's the buy right, very diversified, and the hold tight is what we've talked a little bit about, and that is, when you get these periods of adversity and fear and greed, don't do anything.
Occasionally thought of it.
Well, let me tell you how I got a letter about 2 years ago, a year and a half ago, from obviously a young man, and he was concerned about his asset allocation. and he said he thinks about all the risks out there, and he can't figure out what to do. So I wrote him a letter, and I ended up ending one of my chapters in the book with this letter, and it said essentially, look, you're young and I'm old and experienced, and neither of us have any idea the outcome of the big risks that we all face today. Nuclear war, religious war, global warming, trade wars, pandemics, the breakdown of governance in our country. You can name a lot more, and every one of them is worrisome, and every one of them, this, let me say, 28-year-old young man has every bit as good idea and ability to predict the outcome of those things as I do, or as I think anybody in this room does. We just don't know. So I would put that aside in my asset allocation. And then I said, you know, this sums up the way I deal with risk. I said, I'm 88 years old, actually 88 and a half, and I said, I'm about 50% in stocks and 50% in bonds, and that satisfies me. And yet I spend half my time wondering why I have so much in stocks and half of my time worrying about why I have so little in stocks. And that is the fog of investment strategy that we never really know. So I think scientific things, mathematical calculations, I would fall back on the name of yet another one of my books called Don't Count on It. I use that to portray the difference between passive index investing and actively managed fund investing. The Hedgehog, the saying from Archilochus, Greek philosopher who just left a few fragments of his work, was the fox knows many things, but the hedgehog knows one great thing. And what the hedgehog knows is that all this fooling around out there does you no good at all. Own the market. It's another way of saying that. And the fox, oh my, are they smart. They're smarter than all the hedgehogs put together. Go down to Wall Street and talk to all that immensely wealthy brain power that, of course, builds nothing because they're competing with other brain power. I'm not saying brain power is wasted. I'm saying the average brainiac is average compared to the other brainiacs. So they can't win. We know that. So, you know, all the secrets. I've got a tip for you. Just buy this, sell that. That's the fox thing. The foxy way to beat the market. Doesn't work.
And the less sexy index funds outperforming the more active brainiac funds.
The index fund, in fact, is an act of extreme boredom. And if you don't peek, another one of my rules that I'm not sure I mentioned in the book, if you don't look, that's in your interest not to look. Why open that 401k statement or your IRA statement every quarter and say either I'm rich or I'm ruined? Just throw it in the wastebasket.
When it comes to investing, I just give my money to my friend Frank over at Name Your Big Wall Street Bank. I don't really know what they're doing, but is such a friendly person. I'm sure that they're taking care of my finances for me. I mean, a huge number of people don't want to deal with this subject. It's like dentistry for them. And if they can outsource dentistry, they're going to be very happy to do so, and they turn to their college friend or friend of a friend who happens to work at a big firm and has been trained to be very friendly with them, and they're just going to hand their money and say, please don't lose it, Frank, and I trust you.
Look at the numbers. How is Frank doing for you? How has he done for his other clients? Why is he trading all the time? Because that's good for him and not good for you. So you should basically, this is not a personal matter about finding a friend. As they say in Washington, you know this, Tom, if you want a friend in Washington, get a dog. And you wouldn't do this with your dog, and I don't think you should do it with your friend either. These are honest people by and large. They don't really realize that the more they trade, more they have you trade, the less well you do. So activity is essentially the curse of Wall Street. If there's no activity in Wall Street, there is no money in Wall Street. Every day, all those $30 trillion of stock that's changes hands, something like that. One person's buying, one person's selling. It creates no value. It shifts value from A to B or from B to A. and the system of Wall Street takes its cut out of the middle. So the gambling, the casino comes up again. You know, the croupiers of Wall Street, like the croupiers of Vegas, as it's called, I believe it's Las Vegas, he said, and you know, all the bettors that bet red and all the bettors that bet black are equal, but they don't divide up the returns because there is the croupier, and he's got this rake, and he pulls his share off the table. So,
Out of your retirement fund.
love Frank. Buy him a drink every once in a while. Encourage him to tell you the latest jokes, which he would probably do if he was the broker. But think about investing as a long-term thing that doesn't involve any trading whatsoever.
Well, the bagel and the donut is a talk I gave years ago, and I contrasted, like the investment world. The bagel is nutritious, good for you, substantive, while the donut has a certain sweetness, and it kind of breaks up and crumbles when you eat it. And so long-term investing, holding on, the strategy I just described is the bagel, and short-term speculation is the donut. Just a way of visualizing, you know, which you want, which is the best for you in the long run. And sometimes people may think I'd just soon have a couple of donuts, but they're not going to do you any good, with all due respect for the donut makers of America.
I expected it to take off two things, one good, one positive, and one negative. The negative is I expected it to take off much faster than it did. It took 20 years until the mid 90s
Right.
for it to begin to gain real traction, and then it accelerated, and the growth from 1995 to 2016 has been astonishing, and it's sustained, and the cash flows are over 100% of the industries. Vanguard leads in that, and of course, and so it's done a lot of good for a lot of people. People say, why doesn't everybody start an index fund? And I said the answer to that is very simple. All the darn money goes to the investors. This is a business.
The money's not in it for the...
Yeah, they're in it to earn a return on the capital, particularly the capital that owns the firm, all those conglomerates that own these firms. And the mutual fund division of that firm, or the mutual fund organization, it's a subsidiary, has to produce a return on the buyer's capital. And if you don't, the buyer will get somebody who will. I mean, capitalism is a hard business. But the capitalism in our business should be focused on the shareholder who puts up the money, puts up the capital, takes the risk, and ought to get all the reward, and he only gets about a third of it over time. So it's amazing to think in this index boom. I was telling someone the other day, Christine, that I've been worried about size, getting too big, for as long as I can remember.
Vanguard's size, though, has really been increasing exponentially over the past.
Yeah, and I'm not saying we should stop it. You know, I used to have these arguments with the directors about slowing down our growth, and they said, well, look, you do that, and there'll be a whole lot of investors that deserve to be in Vanguard that won't be there. And so, in any event, I've been worried about it for so long, and in a speech I gave in 1989 to the Vanguard crew, I said, you know, we're starting to get big, and I hope we're very careful as we get bigger and bigger. I'll do my best to make sure that Vanguard is always a place where judgment has at least a fighting chance to triumph over process. And this last 50% decline, one of, I think, 4 I've experienced, they're all different. That's one really important thing. Don't say I've seen all this before. Very few times does the same thing happen twice. And in the financial markets, the same problems happen twice. Yeah, each one is its own. There's some statement like, all happy families are alike, and all unhappy families are different, but all unhappy families are alike in their own way, or something like that. And the problem here is that all these bear markets are very, very different, inspired by different things, sometimes mathematics, sometimes investors' emotions, and sometimes by external factors.
Now, first, to be crystal clear on this, I couldn't care less if an investor decides to go into the Vanguard S&P 500 ETF or into the Vanguard, I had to create a word for this, an acronym to go with ETF, TIF, traditional index funds. They both own exactly the same portfolio. They're both part of the same portfolio. Their returns will be identical. They both go for around 5 or 6 basis points at the Admiral class level. We had many, many years ago when I was running this place, and I perceived a little bit about the future, and we put on a pricing thing where you got higher returns as your average investment rose. And I think now the Admiral threshold is maybe $10,000. So if you're down below 10,000, you're probably paying 10 or 12 basis points. So once you get to 10,000, and they will be identical. So I couldn't care less. If I have a little bias against the ETF, it's because you may say and believe that when trouble comes, you will not get out in the middle of the day. The middle of the day, I mean, come on. It won't be the point of that at all. But as long as you avoid that temptation.
Because then you can sleep that night. That's the reason people get out in the middle of the day.
Oh, wait a minute, though. The market went down 300 points in the middle of the day. You got out, and it went up 300 points at the second half of the day. I mean, a lot of bouncing around. It's meaningless. But in the long run, that's a nuance, no difference whatsoever. So, fine, and fine for any broad market index fund, in which I would include the total bond market with some limitations, the total U.S. stock market, the S&P 500, international, and even if you want to put a little chunk into emerging market funds, all total market funds. So the idea of investing with the fruits and nuts is just, we had, when these funds started, somebody brought out, I don't think this is much of a name, by the way, a fund called Emerging Cancer ETF. And first of all, it should have been curing emergency cancer or something. It sounded like they were hoping everybody would get emerging cancer. And I criticized that particularly in an article I wrote about ETFs in the Wall Street Journal. And the guy who started it wrote me I thought a kind of plaintive letter. And he said, look, I deserve the same chance to try my ideas as you deserve when you started the first index fund. Well, is there a difference between selling quality and selling junk in your first idea? So I guess I gave him a nice answer. Go for it, man. Emerging cancer is long gone. But have things changed? No. Now we have a cloud computing ETF. A cloud computing ETF. I mean, it almost sounds like the way they're computing the ETF, but they're talking about, I suppose, corporations that are involved in cloud computing, which I would have said was every technology company in America, but I don't claim any expertise in that area. So there are these funny little, it's a great big marketing business. Think of something no one else has ever thought of. And therefore, at this level, the crazier the idea and the stupider the idea, the less it is that other people have thought of it. And then you get bet on the market. I know that's not enough gambling for you. So we'll bet on the market with 100% leverage. Yeah, that's not good enough. 200% leverage. No market there. Bet on the market with 300% leverage. The market will go up 3 times and down 3 times, or down, you have your choice, as your investment. What sense that makes is beyond my comprehension.
Last month on Louis Rukeyser, you summed up your investment philosophy as buy everything and hold it forever. Do you still subscribe to that in light of what the market has been doing, or would you unload some things now?
No, my theory is not subject to the ups and downs, the peregrinations of the stock, the unpredictable peregrinations of the stock market. It's painful to do, but I think the idea of owning the stock market is the best approach to equity investing, and perhaps I didn't make that thoroughly clear there. I have never felt that equities should be the only portion of an investor's long-term program. I myself am about 50% stocks, 50% bonds, for example. I was brought up when I came into this business in 1951 with the Wellington Fund, which was and is, and I hope always will be, a conservative balanced fund. But I think the idea of buying and holding forever and not trying to make adjustments requires that you've gotten it right in the first place. That you can only hold tight if you've bought right, if you will. And that is to say, have an asset allocation that has something to do with how many years you have to accumulate money, how much resources you have at stake, how much income you need, and how much courage you have to ride out the peregrinations of the market. So you've got to take all that into account from that simple statement.
You are the godfather of index funds aimed at the average investor, and this questioner points out that actively managed funds have outperformed indexed over the last 2 years. Is there a case then for market timing? What should you do when the index funds are losing money?
Well, as my friend Jim Glassman quoted me in his op-ed piece in the Wall Street Journal yesterday, it's a quote I don't even remember where I made, but it said, I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market. Last year, these last 2 years, the index, S&P index, has outperformed roughly half of the funds, a little bit less last year, just about half this year. I don't regard that as a significant long-term sign at all. First of all, the number of funds is not a relevant statistic. We use it because it's convenient. But if you've got a few little funds in there that do well, they count just as much as a few big funds. The reality is, no matter what the statistics tell you, indexing always wins. I say that because index is delivering the market return, and all those investors out there are by definition getting the market return themselves, less cost. So if statistics don't capture that index advantage, it will be corrected in the next year or the next year. And by the way, if you look at even the last 15 years, counting those last 2 years, the index has outperformed about 75% of all active managers.
Someone out there will want to take careful notes here because we're going to go from the general to the very specific. For the past 15 months, I've been investing $1,200 per month in Schwab mutual funds. He or she doesn't say which Schwab funds. Should I continue, or is there a better place for that money these days?
Well, far be it for me to get into more trouble with Mr. Schwab than I'm in already. But leaving aside the infinite variety of a stock of mutual funds they could be buying through any kind of a mutual fund marketplace like Charles Schwab's, the answer is yes, continue to invest. I've told particularly young people in the office who are really petrified by this market decline that it's the best thing that ever happens to them. And if you think about it logically, of course it's wonderful. I mean, think of, say, the young man I was talking to yesterday who's probably 25 or 26 years old, and he's got the rest of his life in invest. And I said, well, let's suppose that Chris Scott, his name is. I said, let's suppose, Chris, that the market's going to end up at Jim Glassman's 36,000 by the time you retire. Do you want to be investing all your money when the Dow is at 35,000, or invest it all when it's 9,000? Just think about that for a minute. In other words, you want a long time to invest at low prices, and it's certainly a frightening advantage for those of us who have some money at work in the market today to think of this as a blessing. But it is a blessing because in the long run, investing depends on accumulating money at sound prices and not inflated prices like we have. I also think the general economy and the financial markets are well served by a return to reality. When you leave reality and depart from the laws of gravity, there's nothing but bad things that can happen, and the higher you fly, the more you fall. We flew quite high enough, and I think it's a blessing, maybe a blessing in heavy disguise, a blessing that we've come back a little bit toward the ground.
Speaking of coming back toward the ground, this investor's stocks are really down. Dr. Koop, just for feet. Is that Quigley Pharmaceuticals? Cisco, Lucent Technologies. Should I sell?
I haven't heard a list like that. He even makes those tech funds I told you about seem like heroes. I don't have any comment on those individual stocks. I mean, they are hugely depressed. I think Dr. Koop, I read the other day, is in danger, the stock is in danger of becoming delisted. I think it's sold up in the mid-30s, $30, and now is something like 19 cents. It wasn't a good turn. And it's very painful for people, for speculators, or people that greed overwhelm their good judgment to get hurt. But will they bounce back? I mean, I guess the answer to that group of stocks, without knowing much about Quigley's Pharmaceutical and being very nervous about Dr. Koop, is, companies like Lucent will come back. in time. I don't think there's much question about that. But to own a handful of individual stocks, I don't think is sound investing. And to obviously jump on the bandwagon at a silly time is, I feel very, very sorry for the investor, but I don't know how to help him now, him or her.